Hi, this is Andrew Yomilkowski with Heartland Credit. Let's talk just for a minute. As you're going through credit repair, the idea typically is, I want to get my credit up so that I can qualify for a home loan. Well, we're going to isolate over the next few videos some individual components that you maybe aren't being talked about to prepare you to understand what's going on inside the mortgage process. So what I want to talk a little bit about on this one quickly is, what is mortgage insurance? Mortgage insurance, frankly, offers no benefit to you, the consumer. It is required by the lender to protect the lender. And a lender will require you to have it if you have a more than 80% of the value of a property as a home loan, or 80% LTV or greater on a single loan. So if you borrow 90% of the value of the property, you're gonna have to pay mortgage insurance. Mortgage insurance is an insurance that the lender requires you to pay them to protect them in case you default. This is where your credit score is really important though, and I'm gonna try to give you a simple theoretical example that's pretty close. On a $100,000 loan, okay, even if you have a 620 credit score, so you get approved from your bank and you're gonna do a 90% loan to value, which means you're gonna put 10% down, so you would be required by the lender, because you're more than 80% on a single loan, to carry mortgage insurance. A 620 credit score, you might have the mortgage insurance because of your credit score, might be $100, $105 a month. Now a 60-point change, so if we work your credit for maybe just be a little bit more patient for a couple months and let us work with you to get you up to over, let's say, a 680. So 620, about $100 a month. 680, you're only looking at about $60, $65 a month for that mortgage insurance. So if you think about it, on one hand, you have the price of the home. On the other hand, you have the interest rate itself. But then mortgage insurance, anytime you're not gonna put 20% down or do an 80-10, which would be an 80% one loan and then a 10% second, or an 80-20, which would be an 80% first and a 20% second, you're gonna be required to pay mortgage insurance. So think about that. Simply 60 credit points, the difference between a 620 and a 680 could be $30, $35 a month. And you're gonna probably pay mortgage insurance, if you don't refinance, for a good 7 to 10 years. So if you think about that, when we get asked questions of why should I do credit restoration, or why should I work with a credit restoration company, if we can take you from a 620 to a 680 in, let's say, 3 months, that's $30 a month you're gonna save just in mortgage insurance. That's roughly $360 a year, and if you have to pay for the first 10 years of your home mortgage loan as you pay for it, that's over $3,000. If you didn't have to pay the mortgage insurance, or you were able to pay the lower factor, you could buy a heck of a lot more house. $50 a month is maybe the difference between buying a $110,000 home and a $140,000 home. So these are examples where investing in your credit pays huge dividends long term. And we certainly love to be able to educate you a little bit on mortgage insurance. It's a big part of the mortgage equation that most people just don't think about, and it's all about your credit score and what you're putting down. Thanks.